But yeah, if anyone's seen it, might not be snowing where you are, but it's snowing on AdviseWise. I'll leave that one to you to go and find out. But it's snowing on AdviseWise. Go and find it. Right, I think we'll get cracking, and we'll keep letting people in the background. But welcome to the last lender webinar with AdviseWise of 2023. I almost said 2024 then, because we've been joking about how many days it is till the new year. Yeah, so this is the last webinar. So thank you all for joining us. I know it's quietening down a little bit. We are in December, but we are seeing lots of movements, lots of happenings within the sector. It's been a long year. It's been an eventful year to say the least. But I just wanted to sort of start this session with a few numbers, a few dates for your diary, just to get you guys thinking and engaged this morning. So you'll probably be reminded constantly if you've got children in the house, but it's 11 sleeps until Christmas. It is 18 days until 2024. It's 19 days until I have a shave. I'll leave that one for you to work out as well. Winter solstice, so the longest day is in 8 days, and then we have to look forward to throughout 2024. Summer solstice, the longest day is in 189 days, and then the last one. Selfishly, I'll let you know that I'm getting married in 273 days. Yeah, that's going to whiz by, I'm sure, September next year. My name's Daniel Edmondson. I'm the National Account Manager here at AdviseWise, and I'm joined by the very experienced Matthew Latham, Specialist Account Director at Just. We've got a great session ahead of you today, but just as standard, we like to go through a little bit of housekeeping just to keep you all informed. We are well experienced with these Zoom webinars by now, but just in terms of housekeeping, if you just be conscious of your mics, your cameras, and I'm not going to say action, I'm going to say questions. If you have any questions, we're more than happy for you to unmute, but just be conscious of the viewing experience for everybody else. Obviously, this session is being recorded as well, and you can also utilize the chat box at the bottom of your screen. If you haven't found it yet for all these years, it's at the bottom. You click, it's next to the mic, the camera, and there's the chat box there as well. We would encourage you to think of some questions. Obviously, think about, how can we enhance everybody else's learning on this session as well, and it really does help. So I sort of ask you if you can think of some questions, comments, feedback, experiences, case studies, anything towards the end of the session. It is incredibly valuable to enhance this for everybody listening. In this webinar, Matt is going to cover the personalization of advice, why it's so important and what you can do surrounding it. So uncovering the secrets behind tailored financial guidance, the FCA requirements, staying ahead of the game with the latest regulations, the how-to, so actually learning the ropes of personalization and what that means for medical underwriting and what that means for interest servicing. So somewhat specific to the Just proposition, but also we know that these things are covered throughout different lenders throughout the market as well. So we want to make sure that we're getting the best possible rates, features and plans for our clients at the end of the day, having a really personalized experience. And then, as I mentioned, we've got an opportunity to have a Q&A, a bit of a discussion. So if you've got those burning questions, please do make an effort to ask us here as well. Before I pass you over to Matt and his very capable hands and the presentation, just a reminder that anything medical, anything interest servicing, we do have live rates on AdviseWise. Years ago, there used to be guide rates. You used to have to go to their systems and get the actual rates, but everything's API linked now. So what you see is what you get on the platform. So hopefully some reassurance there for you to go and do some test quotes and seeing what's available to you and your clients. In terms of a brief market update from my perspective, we were joking just before the session. I'm sure nobody monitors the gilt rates as closely as myself and my CEO, Jonathan. We were watching them like a hawk yesterday, dropping below 4.2, and the lowest we saw was 4.037. Now, that's quite a significant shift over the last month or so, certainly more than half a percentage dropping down earlier this week, and it's likely to be motivated and surrounded by some of the news that's been released on the economic performance throughout October and some of that data that's been released. So watch this space. There probably will be a bit of a correction. There often is. A lot of these fund managers that buy up the gilts, they expect that drop when data's released, so they'll be buying some up. There'll be a little bit of a correction, but it's moving in the right direction. I think that's safe to say. We know that the base rate is holding 5.25, and inflation rate, as you know, it's sitting in the region of 4.7. So Rishi's doing his job there. The next lot of data, the inflation data, is set to come out next Wednesday, the 20th. So watch this space and certainly look on your news outlets for that. In terms of rate changes across the later life space, we've had 26 rate changes month to date. There's only 14 days gone past so far this month, so it's all very promising. Only one of them has been an increase. So again, extremely strong. So 26 month to date. November, we saw 54 recorded rate adjustments, which is a massive shift from October, which was 25, and September, which was 12. So again, lots of changes, lots of activity in the space, which is obviously extremely positive. But I'll now pass you over to Matt Latham, and he will go through a presentation and hopefully give you some amazing content to help you enhance and personalize your offering into 2024 and beyond. Thank you.
Perfect. Thank you, Dan. Really appreciate the intro and for being quite statty at the very start. I do like a number myself. There's no doubt. I am often accused of being a nerd, and I'm gonna wear that quite happily. Actually, I do like a spreadsheet. I do like a number. I think we're probably all in the same boat on that. So my name is Matt Latham. I'm a specialist account director here at Just, and I look after the relationship between some of the larger distribution partners and Just, and actually not just in the lifetime mortgage market. You mentioned gilts. I think I've got a few actuaries in our head office that probably survey the gilt movements a little bit more, but we work in the retirement space in the annuity market, and the annuity market is highly linked to gilts, as the lifetime mortgage market is as well. But I really appreciate all of your time, and actually giving some of your time up to listen to me today. I'm just going to share screen so I can get you onto my slides. So hopefully you will have that coming up in front of you now.
Yep.
And as Dan mentioned, what we really want to do today is start to look at the personalization of advice, how you can make products and your advice fit your client's circumstance. And we know from the FCA, they've used the word personalization so much over the last 5 years across every single area that comes within the FCA remit. So it is something that we need to do more and more of. Now, you could suggest that that's meaning that products are becoming more complicated, and there are some challenges that come with complicated products, but if they are more specific to customer needs, then it is going to drive better customer outcomes. And where your job is made easier is where you have a sourcing tool like AdviceWise that you put the information in. It does all the hard work and gives you back the solutions that you are then able to choose from your customers. Then actually that makes these more complicated products easier for you to understand and to source, and therefore better and easier for your customers to get the right solution for them. So we've mentioned already some learning objectives. So I just want to take you through that. So this is going to be the basis of your CPD for today's session. Understand the lifetime mortgage market, to explore the recent FCA advice feedback, understand the importance of health and lifestyle underwriting in relation to lifetime mortgages. So whilst it's going to be specific to Just that I talk about today, there are other providers and lenders in this marketplace that utilize medical underwriting. So whilst it will apply to the market, I can only obviously talk about Just products, but it is useful for you and other lenders out there. And then understand the benefits of interest servicing for your customers. And again, whilst I'm going to be talking specifically about the Just product, other lenders are able to help assist customers in controlling and maintaining their debt through servicing of interest. So when you've got the right client, it is definitely the right solution when they've got the right circumstance and surplus income, etc. So they are the learning objectives. There is an agenda for today. It's not random. You'll be pleased to know there is some structure to what we're going to talk about. Look at the market overview. You might say it's a bit perverse looking at 2022, but of course that's the backdrop to where we are and some of the challenges that some of my accounts and my colleagues and your colleagues in the market have faced this year. Look at opportunity and need. It's really important when we've gone through a challenging year to focus on the demand still, and that's a really important part of this, is what are customers needing, what are we supplying ultimately. And it's a really important thing just to remind yourself of those needs. Look at the regulation, as I mentioned earlier, look at our medical underwriting product, and then look at interest servicing. So let's start with that bit that I might have suggested was a little bit perverse, of what the market looked like last year. Market of 6.2 billion, and that was up. We know all of these numbers. So what's it really going to look like as far as this year is concerned? Well, I think it's going to be just shy of 3 billion or thereabouts. What do we expect to see for next year? Well, I think the really nice thing is we've seen some real stability, and Dan mentioned about rates coming down and products improving over the last quarter. And that's a really important part of what next year, excuse me, will look like. 2024, we do expect to see more demand, and we predict an increase on lending from 2023. So we've got some stability now, and we've actually got some improvements, and that's a really good thing for advisor confidence and customer and consumer confidence. So already mentioned gilt yields. These gilt numbers were just taken from a few days ago, so there's a couple of days out of date. But you mentioned about low gilt yields. Down, I'm just going to use my cursor. You'll see that this down here was pretty much the lowest we saw, and I think that was 0.23. So that's where we've come from, and it's been historically low since the since the credit crunch, I suppose, and gilt yields have been in an unnatural environment, so they've been artificially low, and ultimately all we're doing is we're returning to a position where they're more normalized, and that's a really good point. So whilst we are seeing improvements now, I think the gilt yields aren't going to deviate too much from where they currently sit, certainly not, I don't think, in the short to medium term. So we do need to be a bit comfortable and confident about the levels that they currently are at, because this, as you can see, this big dip here that we've all enjoyed and customers have enjoyed, it had to end at some point. I don't think anyone was fully expecting to see the trajectory of it ending and how it ended, but this, I think, is a more natural environment. So this is where we need to start positioning our minds and getting the right mindset. Is this is the new norm for the time being. We've mentioned the base rate. We've got some stability in the base rate, and what stability does is it means that people are less likely to sit on their hands. When there is turbulence in the market, a number of clients and customers will just bury their heads and wait for something to change. With stability, you get a little bit more confidence, and that will only help our market. So that's, I think, some really good signs that we've seen over the last quarter, and I think we should all be fairly confident that we start to see some growth and some improvement from here. But I did mention going through things like opportunity and need, just remind yourself of the demand. Now, this is an old slide, but it's still relevant. And the reason I put an older slide up, and this is the sort of slides that we were going through a couple of years ago, is demand hasn't changed. You know, demand has fundamentally not changed. The environment that the demand in has changed, but the demand hasn't. The aging population, we are all living longer, which to some degree is a positive. Unfortunately, when you dovetail that with a pension landscape and people having lower pension funds than they need for the retirement that they really wished for, well, if you're living longer, that puts even more strain on that. So there is going to be a demand of retirement income based on those two factors. We've still got things like interest-only mortgages. So 2032 is going to be the peak of maturities for interest-only mortgages. So that's not going to go away. We have seen some lenders be a bit more flexible in their approach to later life lending and extending terms to help customers out, but there still will be maturities in the marketplace. We've got a changing attitude to lifetime mortgage as well, where we've got things like the FCA talking about lifetime mortgages and how they are appropriate to the right customers. And then you've got even more, I suppose, public, not necessarily endorsements, but people like Martin Lewis, money saving expert, saying how equity release can be used in the right circumstances. It's good for customers and consumers. So we've got now, I suppose, we've moved away from the bad press that equity release and lifetime mortgages had from a decade or so ago. Increased customer awareness. Well, I'm just going to focus on this one a little bit, because I think there might be a challenge with increased customer awareness, because currently what we're not seeing, because of the market challenges, what we're not seeing is that sort of TV advertising campaign that we'd seen previously. So you'd go back a couple of years and you'd be watching the X Factor or whatever you watch on a Saturday night, and you'd see TV adverts for lifetime mortgages from various different companies. And that hasn't, that sort of marketing has no, well, it's not currently in the marketplace. So is customer awareness increasing? Well, at the moment, I'd say at best it's probably plateaued, but it will be time. We've got next year, we expect to see a bigger market, and we'll start to see people being a bit more inventive with their marketing, but actually also with one eye, and I'm going to talk about this later, the FCA review, the latest update they gave in September on about financial promotions. So they highlighted the way that lifetime mortgages were promoted, and that may have been a concern for a number of firms. So they're just taking stock, working out the best way of advertising and marketing lifetime mortgages so that they can accommodate all the feedback that the FCA gave. Cost of living, don't really need to go into too much detail on that. We're still in a cost of living crisis. Whilst, and Dan mentioned, inflation has gone down to 4.7%, that's still a challenge for a lot of people. It feels like a bit of a success, but actually taking a step back, 4.7 is still a very high inflationary rate, and it's still going to be a challenge on where my income goes, where your income goes, and where your customers' income goes. So that's still going to be a big issue. Housing wealth, is going to be a little bit of a strain on housing wealth, but there's still a significant amount of property asset that people have in later life. And then finally, gifting. With the cost of living crisis, people living longer and having property wealth in later life, and the higher amount of property wealth in later life, gifting still a significant part of this marketplace. So whilst this is an old slide, it does, I think, highlight most of the areas of demand that we are still going to see in this marketplace. And I'm going to go into a bit more detail on some of these points. The aging population. Now, I used to think this is quite a positive. I'm sort of in two minds now. The older I get, the more of a two-mind thing I'm in. I now suffer from bad back. So living longer with a bad back, I'm not sure if that's a good or a bad thing. Ultimately, that's down to me. I should move more, but probably a different time. I'll go into finer detail on that. But let's look at how population has changed. We've got babies born, baby boys born in 2020 will have an average life expectancy of 87.3 years, but just be a couple of decades later, and you can see how that's extended by nearly 3 years. And if you've got to live in retirement for an additional 3 years, that is going to put pressure on the resources you have available for your retirement, which is your pension pot. For girls born in 2020, average life expectancy is higher than boys, as you probably appreciate, so just over 90 years, just a couple of decades later, and they've got a nearly 2.5-year extra life expectancy to live. So the life expectancy changes we've seen since the formation of the NHS, wonderful service, has meant that we've all, on average, I think life expectancy has changed by about 2.5 years per generation. So you add that all together, then we are all living 15, 20 years longer than we probably expected to. Now, of course, talking about babies is probably not relevant to the lifetime mortgage market, so let's look at our demographic. Males who were 65 a couple of years ago will have an average life expectancy of nearly 20 years, but males who reach the age of 65 in a couple of decades' time will have another 2 years on top of that. So again, just to highlight how life expectancy is moving on, and for females, it's a similar story, an extra 2 years. So that is the pressure that people will find themselves in. And then if you talk about average life expectancy, let's take that even further. It's a wonderful calculator by the ONS where you can put in an age, gender. It will calculate your average life expectancy and then look at the chances of living even longer than average. So for an average life expectancy for a male age 70 is 86 years, but to live 6 years longer, you've got a 1 in 4 chance. To live 10 years longer, you've got a 10% chance, 1 in 10. And to live to 100, you've got 2.7% chance. And if you are fortunate or unfortunate, depending on your circumstance, to get to 100, can you imagine the pressure that is going to put on your income and your assets to live the life that you want to? And that's basically all we've ever been saving up for in our pensions, to have the retirement that we deserve. Unfortunately, not enough people are thinking about that all the way through their pension life. Cost of living, well, we know already, Dan's mentioned that inflation at 4.7%, and we can see this peak up here, and you go back to 89, and it's about the same sort of peak. So we're actually, if you look at that, we can see how this recovers over a few years, and we've still got a couple more years of this in us if this still carries on, but it's going in the right direction, and it's certainly taken a lot of the pressure off a number of us. We've got customers out there who've got final salaries, and they're likely to meet people's needs. But as we well know, people with enjoying final salary benefits are on the decline, and people are in defined contribution pension schemes aren't generally saving as much as they can or as much as they should do. And actually, with the cost of living crisis, we know that things like pensions are the things that people start to cut back on if their income is under pressure. Life cover, we know, is one of the first things that goes, but pension contributions do reduce, and there's plenty of evidence to suggest that's happening. And all that's doing is setting up a bigger issue in later life. So don't forget, we're living longer. And if you cutting your pension contributions because of the cost of living crisis, that's going to have a compound impact on how you get through your later life. The housing market, is it turning at the moment? Well, the evidence suggests there is a bit of a correction. I've got kids, and part of me thinks, well, actually, look, I appreciate it's the biggest asset and people are very precious about their property assets. But was all this growth sustainable? Are my kids going to get on the housing ladder as I did? I don't think the youth or younger generations are going to find it as easy. So this might be needed. There's no doubt about that. But actually, we've seen corrections before. We saw a correction just after the credit crunch, and it didn't take long for it to recover. So it just sets you back a few years. But nonetheless, people with property assets can use it for good and for giving themselves the retirement that they want. And to take that even further, if you look at property wealth for 55 to 64-year-olds, and it's nearly 50% of 55 to 64-year-olds have property wealth of over £250,000. And that's a significant amount. And when I say property wealth, that's taken off any mortgages that they may have. So this is their true property wealth. And for those, I suppose, that are probably more traditionally aligned with our marketplace, 65 and over, it's 45% of the population have property wealth of over £250,000 for that age group of 65 plus. And this is what you're helping your customers access, to dip into part of their assets that they've been paying mortgages on all their lives, to give themselves an alternative lifestyle in retirement, and just to use that wealth for other means. Now, I did mention that we'd talk about regulator, and we go back to 2020. So I'm just going to go through a very brief overview of the last sales and advice review that the FCA gave. And it wasn't a massive review, I will say. I mean, we've looked at thematic reviews before, and they've come in hundreds of pages. The review that the FCA did on the equity release market was probably only about 8 pages in total. So there wasn't a massive amount of areas of concern by them. But the 3 areas that they did fundamentally highlight was insufficient personalization of advice. So there's that word again, personalization. They talked about the insufficient challenging of customer assumptions. So that is really, are you giving a client what they want, or are you giving a client what they need? And there's a distinct difference. So as advisors, our job is to tell a customer what they need, and that might be different from what they want. But good advisors will be able to say, look, you've asked for this. In my advice would be, you don't necessarily need this, and it could well be just saying having a reserve of £75,000 in the bank. Well, unless there's a specific need for that £75,000, do you need £75,000 there? Could you borrow less? And that's the kind of challenging of a customer assumptions that the FCA have highlighted. And then things was just evidence. So whether our evidence is good or bad, do we have the sufficient information to back up our advice? And that's a really important part of that. So just making sure that you can back up through independent eyes, third parties, when they look at the advice, if they look at all the information you've got there, does it confirm all of the things you advise the client on? And so they're the 3 main areas of concern. I'm going to go into a little bit more detail, but not spend too much time on there. But then again, as far as personalization of advice, looking at not sufficiently accounting for the different financial circumstances of the customer, wholly or relying in any way on just the KFI to show the customer the long-term costs. So good advisors are able to look at KFI, run through it as you should do, but then explain the things of the KFI. It is quite a long document, and there's information on there that is hard for most consumers to understand, and a good advisor will be able to take them through that and not just read it verbatim, but explain it in words that customer understands. And it could well be different. It will be different understanding from customer to customer. Impact of debt consolidation was not properly explored. I'm going to talk about that again in a minute. The customer's financial circumstances not being given sufficient weighting by the advisor. Advisors recommending changes to property ownership. And again, all things that provide or produce an additional level of risk to consumers. So the second thing the FCA highlighted was challenging of customer assumptions. So, and this is one of the reasons why we're talking about interest servicing today. Customers with a substantial monthly surplus income stated they did not want to commit to making monthly payments. Now that might be right. That absolutely might be right. But good advisors will say, I've identified you've got substantial monthly surplus income, and I think you should use it to service debt. Or service your lifetime mortgage. Now, ultimately, it's still up to the customer about whether they do that or not, but it's down to the advisor to say this is what you should be doing. And that's, again, something to document. I've recommended you do this. You said you didn't want to. You're now going to do that, but you cover it off and you tick the box. And that's all about doing the research properly. If you identify the surplus monthly income, what are you using it for, Mr. Client? Advisors accepting without question customers not wanting to pay upfront fees, adding them to the loan. So a fee, once added to the loan, can grow substantially, as you well know, with compound interest. So, and it sort of feels counterintuitive when a customer is coming up and saying, well, I'd like to release some money up, but could you pay your fee? Could you pay your fee yourself? Sort of feels counterintuitive, but advisors and good advisors will say, well, actually, you've got money. Why don't you pay the fee upfront? And then the customer's desire to refinance debts into a product with no monthly payment. So again, things like what you're doing with debts. And they talk about that in the suitability of advice as well, which I'll just go through now. So the overuse of generic wording and not using what customers' wordology and their phraseology, so how they think things are. And good advisors are able to personalize the way they present things to suit the customer's individual needs. Customers' interactions not properly recorded. That goes back to the evidence I mentioned earlier. Suitability reports need to be clear, fair, not misleading. Well, that stands to reason. I'm quite surprised that actually the FCA wanted to highlight that. I think we all would be fully on board with that anyway. And then finally, what the FCA did is they said, right, here's your school report. So these are the things that we'll be looking at again in the future. Firms need to ensure that they take reasonable steps to obtain the right information for advice. Get that? I don't think anyone would argue with that. When giving advice on an equity release transaction, you need to make sure the advice given is suitable. Again, get all of that. Firms should ensure that they collect and retain the necessary evidence. So these are the things the FCA said, look, these are our areas of concern, and this is what we're going to be looking at going forward. So they gave an update to that in September. And basically these were their findings. So they looked at financial promotions first and foremost and said, look, they need to be accurate. The product benefits need to be highlighted with a balancing description of risk. So whilst the product does this, this is the harm or the risk that is involved. And firms using their FCA regulated status in a promotional manner, well, it's a necessity. It's not an advert for FCA status. That's what you should have. And I sort of get that the FCA are a bit precious about that. The other area, the suitability of advice, they talked about poorly considering borrowers' income and expenditure. For me, that seems to go back into interest servicing. If you've got surplus monthly income, what are you doing with it? Minimizing discussions around the alternatives, have a balanced view. So lifetime mortgages are not the only solutions. You need to look at all of the alternatives and make sure that actually one product is not being incentivized over another, and actually you remove all kind of conscious or unconscious biases from the advice process itself. And then steering outcomes in favor of lifetime mortgage, again, that goes back into that bias thing I've just mentioned. And then they also looked at things like, you need to communicate clear, fair, and not misleading. We know that already. Ensure communications are timely and understandable. Tailor advice to individual circumstances. Mention this, and you'll get this kind of common theme all the way through this presentation. Tailoring advice. That the two product features I'm going to go through today: medical underwriting and interest servicing. Interest servicing we've mentioned a fair few times. Medical underwriting, someone's state of health is a really important part of advice. And in some circumstances, for those who have been in this market a while, you will have given advice before for customers purely down to their medical circumstances. So it's important to document it, it's important to record it, and it's important to use it where necessary to get the right solution for that customer. And when I talk about medical circumstances being one of the main reasons for lending, things like home adaptations. We, after just coming through COVID, a number of clients within our demographic had suffered quite badly, as we all had suffered in lockdown mentally. And for some customers, they had suffered, having suffered from COVID. And there was a lot of people that actually said, well, I've been through quite a traumatic time. I'm not necessarily enjoyed the last 2 years. I've had a health scare potentially, and I want to do something with my assets now. And that was sort of life's too short brigade, I think, is probably not the right phrase, but nonetheless, it's, I want to do something now. I want to enjoy myself. So health has a real fundamental bearing on a lot of lending needs. So finding that and recording that information is really powerful. And then ensure balanced product discussions. Again, that doesn't, it's not going to surprise anyone, and have no commission bias. Managing conflicts of interest and risk of bias. Just make sure when you're giving advice that the solution is the right solution and not the solution that you want. It's what the solution the customer needs. And I have absolutely no doubt that everyone on this call now will fully understand all of that. And it's not, was this aimed at lifetime mortgage experts or people that have been in the market? Well, it was aimed at everyone. There's no doubt. I just think that people that are in the market that are, really providing advice on lifetime mortgages are probably less, or there's less of a need to change or alter what you're doing. But ultimately, we have to fully focus on the FCA feedback, and that's where we are. So that's the update that I wanted to give. I now just want to take you through some of the medical underwriting, and I know Dan, having worked very closely with AdviceWise to get medical underwriting on your portal, and you are very early adopters of that, and we are very, very grateful. Medical underwriting, and one of the questions I'd had from another session was, how do you get underwritten quotes then? You can get them on the portal. They are, you put the information in, you get a guaranteed binding quote right there and then, and you can even apply online now through AdviceWise. You don't have to come into our provider portal. You can do it all from AdviceWise, and it's a one-click magic link. It does actually take you into our portal, but you don't have to re-key the information. It is all sucked through the system, so that when you are going and ready to apply online, it is there. It's a simple process. The medical underwriting is a simple process, and I'll take you through that in a bit more detail. So medical underwriting, for those who don't know, where it differs from normal lifetime mortgage lending is, well, traditionally you just use age and property value to work out the lending that you can give a client. Now, when we say age, we, with medical underwriting, we apply an age based on their medical age and not their birth age or their passport age. And by using medical age, if life expectancy has shortened, that allows us to use and improve the terms. So if, as an example, you've got a 70-year-old that's got some medical conditions, some serious medical conditions, that whilst their birth age is 70, their medical age might be 74. And if it is 74 and we've deemed it to be that or thereabouts, then we can use the terms that we would offer a 74-year-old for that 70-year-old. Hopefully that sort of makes sense. But it's a way of us using someone's specific personal individual circumstances to tailor a solution for their needs. And what happens basically is, by using that, we can either increase the loan to values or decrease the rate. And in some circumstances, we can do both. And I'm going to take you through an example of that in a minute. So, and this is not the happiest slide in the world, I will say, but I want to give you an understanding really of what we're expecting to see from your customers. And let's just say the average age of a lifetime mortgage customer is still about 70. What do we expect to see of 70-year-olds? Well, we expect to see them with some health issues in most cases. And these are the sorts of stats that back that up. So 1 in 7 adults in the UK are smokers, and that is a higher prevalence of that in a higher older age demographic. There are 15 million adults in the UK with high blood pressure, significant amount of adults. And again, significant amount of those are in later life. nearly 5 million people in the UK with diabetes. There's nearly 1 million people in the UK that have got a diabetes that don't even know it. So there's a significant amount of lifestyle influences on our health. And unfortunately, 1 in 2 people in the UK will develop some form of cancer during their lifetime. Now, that's looked at, what, 3 or 4 different conditions there. There are, I think, Dan, you were looking earlier. Now, we ask just over 20 questions, but I think there's 30 questions on the AdviceWise system, and that allows AdviceWise to provide you medically underwritten lifetime mortgage terms for both ourselves and other lenders. So it's not just about Just here. There are other lenders out there who use medical underwriting, and I wouldn't be massively surprised if other lenders who don't use it now will start to use it in the future, because I'm going to give you a demonstration of what it means, and you'll see how powerful it can be, and it certainly helps our proposition. We believe 60% of your customers will benefit from it. Now, it might not provide the best solution or the most appropriate solution for your customer, but 6 in 10 will get improved terms. And that's a really important part. So we think the majority of your customers. I mentioned the simplicity of the question set. This is just a snapshot of our question set and the sort of thing that you will see on the AdviceWise portal. And all we're really after is, what is the client's medical condition? And that's a yes, no. And the only real technical questions we ask are, when were they diagnosed? And we'll make it even easier for you by giving you those outcomes. It's fairly intuitive. So things like, have you got high blood pressure? Yes, no, simple. Don't even ask the readings for that anymore. And as you can see here on this bottom example, has the applicant been diagnosed with diabetes? If they have, that's a tick, very simple. When was it diagnosed? Less than a year, 1 to 5, or over 5 years ago. And you can see that it impacts both the first and the second life. Now, for those who are familiar with how lifetime mortgages work on joint life cases, generally the lending amounts are based on the younger life. So for joint life cases, no real difference. If the older life has the medical conditions, it's unlikely to make much of a difference, if anything at all. If the younger life has the medical conditions, then that's going to have by far the most impact. And what we also see is significantly, in a significant amount of cases, for those who've got lifestyle issues, that you'll find both those customers will have medical conditions that will impact the terms we can offer. So very, very simply done. And I've got just a very simple graph here to show you and demonstrate. All fair enough, me talking at you for an hour, which I think none of us are looking forward to. But if I just wanted to show you really what this means, what am I talking about? What does it actually mean? So we've got here our J6 product, which is our highest loan to value product. And without any kind of medical underwriting, you're looking at lending of just over 175,000, and the rate is just under 8.8. By finding out the client's got a high body mass index, that they are a smoker and they have high blood pressure, then we can boost the lending by just over £4,000. Now, being overweight, being a smoker and having high blood pressure, we think is a fairly common circumstance, and that's not severe underwriting. Now, the rate does increase, but that's the lifetime mortgage market. That's how it works. The more you borrow, generally, the more expensive that is. But you can see already you've got £4,000 additional lending there. If you take the severity of medical underwriting up, so again, high body mass index, being overweight and suffering from diabetes, then you're looking at a lending increase of about £7,000. Again, the rate has gone up slightly, but you're talking about £7,000 worth of additional lending. And taking that to the full extreme, for someone who had suffered from cancer within the last year, which is at the more extreme end for us, you're looking at boosting lending from just over 175,000 to way over 195,000. That's additional borrowing of £20,000. I mean, you're talking about the highest loan to values in the marketplace here with medical underwriting. You cannot get the lending levels without this, and that is because we're using people's individual circumstances to increase and improve the terms we're able to offer. It's a very simple process. And I know, Dan, you've asked me about this before. It's our standard process, bar this little section here, which is we reserve the right to ask for a GPR, a general practitioner's report, to prove the medical information that the customer has given you. We don't do this in every case. We select a small percentage of cases to do that. So it's our standard process. And in some cases, we'll ask for a GPR. And in some cases, actually, you can supply that information yourself, or the customer can to you, and you can supply it with the application. That means we wouldn't need to go for a GPR. And that would be things like high blood pressure. If the client has got high blood pressure, then they should be on medication. A copy of their repeat prescription will satisfy that. For someone who's suffering from cancer, they should, in most cases, get what they call an oncologist letter, which is what will go onto your file with your doctor, and that tells you what the cancer is, etc., etc. But if they've got a copy of that, and I appreciate it's a very sensitive area, but if they've got a copy of that and you can supply that with the application, then that might negate the need for a GPR. If in doubt, though, just ask the experts at AdviceWise, or if you've got an account manager that you deal with here at Just, then please just pick up the phone and we'll guide you through those processes. So what are the benefits? Well, we can improve the loan to value, as I mentioned, so you get higher lending, which would satisfy more lending needs. It used to be used a fair bit for IHT mitigation, and it can still be used there. So the more you can take out of your estate, the lower your IHT liability will be. And actually, one of the benefits that we don't really promote as well as we should do, if you do medical underwriting for the initial advance, then with us, you can do medical underwriting on the further advance. And that's a new bit of medical underwriting. So client age 70 does a medically underwritten initial advance with us. They get to 75, want to borrow more. We'd re-underwrite them with their current circumstances. So they're 5 years older. The chances are they are in worse health, or if their health has worsened, we would apply the updated medical underwriting to their further advance. And if they can get the highest lending in the marketplace at the initial advance, they'll be able to get the highest lending in the marketplace with their further advance. But it's not just about loan to value increasing. We can also decrease the rate. And if we decrease the rate, that reduces the overall cost of borrowing, which means the customer can borrow more at some point in the future, potentially. Or if they don't borrow more, there'll be more left in their property. So it's a really important part of customer benefit. Regulation, we've already mentioned that before. Personalise the solution. It is aligned with consumer duty, treating customers fairly, and the recent LTM advice process I've just mentioned. But I think, in all fairness, if you're not using medical underwriting, can you say your whole of market? Now, I don't know if you can really, because they are separate products. And unless you put the medical information in, you can't really say you've got all the products in front of you. Now, medical underwriting might not give you the best product, but the only way you can work out is by using the medically underwritten system that AdviceWise have built into their portal. Future-proof, if you reduce the overall cost of borrowing, of course, that means that they can borrow more again in the future, and you can protect inheritance. If they do not need to borrow more, then actually you'll be able to keep more in the property, and it helps with the transfer of wealth. So that's medical underwriting. I can see some questions are coming through on the chat. I'm going to, if it's okay with you, Dan, I don't know if you want to do them now, or we'll just wait to the end. I'll go through the interest servicing. We've got some time at the end to answer any questions that you may have, or actually any experience. I think this is good. I know Dan mentioned this earlier. If any of you have used medical underwriting before, if you just want to put in the chat what your experience was, then again, we're happy to share that with the group, because the one good thing about Lifetime Mortgage Advisors, that we're really keen to help each other out with processes and the way we tackle things. And we don't really work in silo, and it's been a challenging year. And I've seen more and more advisors willing to help out each other with the way things are done, with maybe complicated cases, or where can I place this? And I've seen more and more of that. And I think that's been a really good benefit that we've seen over the last year or so. So the final thing we're going to talk about is interest servicing, and how we deal with interest servicing here, because we've just changed some of our criteria. So it's quite apt that we've got the time to go through it. Now, it does need to be selected at outset with us, but the parameters are, as long as it's a minimum of £25, all the way up to servicing 100% of that monthly interest. The loan minimum is different from our normal minimum, and that's increased to 20,000. But, and this is the big one, we will give you 100 basis point rate reduction if you service 26% or more of that monthly interest. That's 1 whole percent off the rate. Now, one of the bits of feedback that, Dan, I know you would have had, and actually advisors are on the call today, is rates are significantly higher than they've been for a long time. Customers are getting used to those rates, advisors are getting used to those rates, and some customers are put off by those rates. If you can give a customer 1% off the rate as a reward for servicing their interest, then that is a really powerful and tangible benefit that the customer can see in front of them. And I'm going to show you in a minute through working examples what that actually means in pounds, shillings and pence. And as a BDM, and I've been doing this job for a good few years, these are probably the most powerful numbers I've ever had to deliver. When you see the benefit of interest servicing in numbers, it's easy for you to fully understand the impact, and it should be easy for customers too as well. And of course, when you start an interest servicing plan with us, you do not have to continue all the way through the life of that mortgage, because we understand circumstances change and customers might not want to. So you can convert to a roll-up at any stage. The only caveat I'll say is that when it converts to a roll-up, the rate reduction would be removed. And one of the new developments we have is it's up to 100 basis points. We have a tiered system. Depending on the product you have, the higher the loan to value product, the bigger that rate reduction is. So it increases the impact significantly at the top end. So this is what we introduced recently. So the interest servicing discounts now will range from 20 basis points on our lower LTV products to 100 basis points, as I've just mentioned, on our higher products. There is an immediate benefit for the customer. They can see that, but the reduction of the impact of compound interest is dramatic. And again, I don't want to take you back to the FCA review, but the personalization of advice, the customer's financial circumstances not been given sufficient weighting by the advisor. For example, where customers had significant surplus income recorded, this had little or no bearing on their final recommendation. The saying, guys, you can see surplus income, you need to address what they do with it. There are tools that we have on our website that show how, once you've plumbed all the specific information in, it shows you graphically to the customer what benefit of servicing that interest is. So we've got a way of you being able to communicate the benefits, but I'm just going to say, take you through an example. The last thing I do now before we go into a Q&A, just take you through an example so that I can fully highlight the impact of interest servicing. So in this example, we've got a customer with a property worth 350,000, looking at a 20-year time period. And they want to borrow 120,000 or 30, just over 34% LTV. So that, you know, if they're borrowing 120 from a 350,000 pound property, there's 230,000 pounds left as equity. I've got two examples to run through. These are fairly busy, and apologies, I'll take you through it, and I'm going to use my cursor. Hopefully you'll follow the bits on this graph, but hopefully the numbers you see will give you the right impact. So in this regard, we're servicing all of the monthly interest. So that's why you get the 100 basis point reduction. Our current rate for this is 8.58 on our standard product. So that's this bottom line. So with 100 basis point reduction, you're now on 7.58. Now that means the interest payable per year, it's just over £1,000 different. Does mean the client's got to service £758 a month. And I know not a lot of clients are going to be in that circumstance, but just for the sake of this example, just run with this for me. Because they're servicing all the interest, there is obviously nothing to be added to that outstanding mortgage balance. So as you go through the years, the outstanding mortgage balance remains the same. In year 20, it remains at £120,000. If you're not servicing it, the interest gets added, and every year it will increase. And so in year 20, it's 663,000. So that's a massive difference. That difference is 543,000. So when you redeem it, there's an additional 543,000 pounds worth of asset at that point. The total cost of borrowing for servicing everything at 100% is your outstanding mortgage balance in year 20, plus the interest that you've paid over the 20 years, and that adds to just over £300,000. So the difference between servicing all the interest and not servicing in this example is 361,000. When you're looking at these sorts of numbers, that as a savings down to interest servicing that's about the most powerful number I've ever had to present, and that is huge. There are some reliances on this. I get that. This is a large amount of money to service, and you have to do it for 20 years. But when you're servicing debt, the earlier you do it, the better it is for the overall cost of borrowing. So it's a really powerful thing. Now, where we're seeing a lot of interest at the moment is those clients who are not servicing everything. And so in this example, we're starting to look at servicing 50%. You get your rate reduction. You do have to pay a certain amount of monthly interest. But after year 20, because you're not paying all of that monthly interest, it does get added to the loan. So in year 20, you're looking at £331,000 as your outstanding mortgage balance here. You've then obviously paid £90,000 worth of interest as you've gone through the 20 years. So your overall total cost of borrowing is 422,000 compared with not servicing anything, and you're still saving £240,000 on your overall. And when that comes to redeem after 20 years, there's an additional £330,000 worth of equity remaining in that property. So that's where we're sitting at the moment. And these numbers really should demonstrate exactly the benefits of servicing that interest. Now, that's me talking at you for an hour. So apologies you've had to sort of go through that. Hopefully, though, it's given you a better insight to the sorts of features we've got and the sorts of ways you can access the product and these features through the tool of AdviceWise. It's very simple. It's all at your fingertips and you can pretty much do everything. So just got to put up the important information at the very end. And now I can take a sip of my coffee, which is a bit tepid now, there's no doubt about that, and then open the floor to any questions or any comments that anyone would like to make.
That's great, Matt. I've certainly added some notes and things to take away from my perspective, as I always do from these sessions. There is a couple of questions in the chat box, and I think Vanessa, we'll start with yours if we can, just because we've got oh, in fact, they're both medical, aren't they? I'm just reading through them quickly. But we'll start with Vanessa, and then we'll come to yours, Paul, afterwards, if that's okay. So Vanessa's got a scenario. I guess we can all see it in the chat as well, but I'll just quickly sort of summarize that. She was looking into making a recommendation for someone which happens to be another lender and another product which is traditionally very, very rate driven.
Yeah.
Throughout the fact find process, there was a discovery that the client had MS and a few other medical issues. Obviously, doing the research, then we know that there's a couple of medical enhanced providers in the space. It was Aviva that came up with an interest rate that was over 0.5% lower than what we would all typically deem as the cheapest rate in the market for something quite vanilla. So, a real sort of real life example there. Thank you, Vanessa, of where there was a significant saving. 0.5% interest rate plus, over the course of a lifetime mortgage can make a significant difference to somebody when it comes to redeem that mortgage, when it comes to pass on that to the beneficiaries and so on. And these are the sorts of scenarios that we want to be establishing. And it can be quite a sensitive topic, obviously speaking to clients and diving into their medical situation. And perhaps some clients might not be as ready to open up to that. Certainly if you're giving advice over the phone or over Zoom, or just, you haven't built that relationship with a client. So my question off the back of that, and Vanessa, please feel free to unmute if you want to as well, is what sort of support is out there to help advisors better understand and have these conversations? I'm a new advisor to the space, and I'm going through my fact find, and I've got these boxes on my fact find to go through and fill out. See, it's not very sensitive. Just, have you had cancer? Tick a box. Have you had a stroke, mini stroke, whatever it might be? Tick a box. How many fags do you smoke? In sort of layman's terms, and pretending we're someone brand new to the industry, where can I go for support to help have those conversations? Because I can imagine that's a big challenge for people is opening up and getting the client to open up.
Yeah, I think it's a really good point. And bear in mind that customers may have been penalised in the past for giving their their health circumstances to a financial advisor for maybe like life cover where they had loaded premiums. So it is, the setup and the presentation of why you're asking the information, I think is really important. And it's, and I will say as well, it's the customer's right not to tell you, but in most cases, if you can explain the benefits of giving the information to make sure your advice is as whole as possible, then most cases you should get that. But I do agree it is sensitive, and I suppose this is where if you've got a good bedside manner, I would imagine already that you just need to tease this information out where possible.
Yeah, absolutely. Thank you for that. And Vanessa, thanks again for that. And please do shout up if I've missed anything or you'd like to add any more of those points. And just moving back to sort of Brian's earlier question. So don't forget it. So based on some of the graphs from some of the medical underwriting segments that you did throughout,
Yeah.
it would appear that and from Paul's experience, sorry, I'm getting confused with your brother Paul. The only real benefit is for medical underwriting is on max release. But I think, am I right in saying that's what you were trying to illustrate there? Is max release? Obviously, if you lower that lending, you could potentially trickle over into a lower band, if you like.
Yeah, I suppose because of where our product sits in the marketplace at this moment in time, where we're most competitive is at that higher LTV space. You are right; it was focused on one of the benefits and not others. It can reduce the rate, but the impact is far greater when you're looking to expand and extend that loan to value. But I know, and having looked in the chat, I know the experience that someone's had with Aviva. Now, I can't speak on behalf of Aviva, but you can get a reduced rate with Aviva. So the point I'm really trying to make is, yeah, you're right. It's a good spot. It's going to have impact with us at the moment, more in that increasing LTV space. But if you're doing it for all lenders, you will find that reduction benefit. And I know there's that case that was mentioned by Vanessa where she did get a lower rate through Aviva. So yeah, good spot. You were right. It was demonstrating higher LTVs, but you can get with us and others reduced rates.
Mhm. Awesome. Thanks for that. Maurice, just from your comments just in there, historically, the interest rates from Just have been higher than competitors. Obviously, there's lots of reasons in and around the pricing of that and the type of properties that you wanted to attract. Do you expect some more alignment in the future with sort of a headline rates? I guess it's your sort of strategy as a business as to what type of properties and clients you want to come on
Yeah,
board.
well, ultimately, because we are in that higher loan to value space and we know how the LTM market works, the more you borrow, generally, the more costly that is. That's where we currently sit. We have a broad product range, but where our focus is and where our competitive positioning at the moment is probably not at that lower end. So there are plenty of providers out there and lenders out there in the market. They've all got strengths and weaknesses. Our strength really is that top end at the moment. So that's probably where we are. We're appropriate for where we're sitting in the market currently. And I think because of where we are, we're writing now as much business as we were pre the budget of last year because of the strength of our proposition right now. And I don't know if many other lenders are saying that. And we probably don't have the same lending targets as some of our peers in the marketplace either. Now, we're not small by any means, and we've been instrumental in innovation in this marketplace. We were the first medically underwritten provider in the market and lender in the market, and we were the first lender to have drawdown within our product. So as far as our history and legacy in the market, it's really deep and very broad. But right now, we're probably at that top end of the market more than we are anywhere else.
Yeah. Okay. Awesome. Great points. Great points there. And then from Graham, this is really worth sort of reading through word for word if I can. So just bear with me. So it's worth remembering that taking action to prevent interest rolling up as quickly as it might doesn't just enhance the estate on death. It also gives the client much needed options. Options like moving house or raising additional monies in the future. So it's just that, and again, that kind of links into it directly links into that foreseeable harm part. It's really making sure that we're not being super restrictive over our client and they've got no other options in the future. So yeah, don't take this sort of candidly. We really need to make sure that we're looking into these areas and doing everything we can, not just to capture it on our fact find, but to do the best for our clients and personalize the advice as the sort of whole title for this section is all about. So Graham, thank you for that and thank you for the comments so far. And Vanessa, just going back to the point what we were discussing earlier, is there any support and how people approach those conversations? And personally, I think just being generally a nice person with your clients and sitting down and not being super structured and having a conversation, building rapport. You rightly say you don't complete the fact find directly in front of the client and tick a box, as I can imagine a few people do. Just having a conversation, tell me about X, Y, and Z, your health history, show an interest, take your time. You're not on a timer, you can take the time, and that's why this is a late life product as it is quite a complex advice process, and it requires quite a lot of work as well, and rightly so. Awesome, thank you for that. But if there's any more comments, please do utilize the chat. I'm just looking at the time, and I'll think from my sort of notes that I've gone through, and that will give you a chance if you want to add any more bullet points in. But it's great to see, as in the whole presentation, it's still great to see those motivators of lifetime mortgage still present. There is still a need out there in the market. And you mentioned that, the peak of interest only renewals is yet to come, which is also, really promising and shows buoyancy within our market. Although it's quite tough, we need to make sure that there is still a need out there and we're still here surviving and available to our clients. You mentioned about the plateau, sort of when you talked about customer awareness, the lack of TV advertising. I see that as a positive. If some of the big distributors that you usually see TV ads from have stopped doing TV ads, yet they remain as a plateau in terms of the volumes of business they're writing this year, although compressed year on year, that's a positive, right? So there's a significant drop in market spend, yet there is still activity happening within
Yeah.
the sector. Aging population does make me worry. So my peers and some of my friends as well, they're not so savvy in knowing about later life planning and paying into the pension and getting a house. We live in a generation of renters now, that the young people coming through. So a bit of a concern for the future, but certainly the next generation coming into retirement, tied up with housing wealth, and they'll need to extract that in some way, shape, or form. And just going through some of your stats, just to reiterate, 1 in 7 are smokers, 1 in 2 people will develop cancer in a lifetime. And probably the biggest one to mention here was 6 in 10, 60% of your clients could get improved terms. Not to say that that's always going to be the top of your sourcing, but it's important to capture that information and illustrate that throughout your research. And I'm glad to say that, we have direct API links and we have live rates on the AdviceWise platform. So do take advantage, do utilize the filters where possible. And as I said, it can impact max lending, and it can also impact the rate if you're sticking at the same lending amounts there as well. But I can't see any more questions. Matt, do you have any other points to mention just before I put the closing in?
I suppose the only other thing is, and I sort of just to reiterate that using medical underwriting won't just benefit us as a lender. Yeah, and that might seem a bit funny. I'm trying to promote other propositions, and to a degree, I think that's probably right. It's where we should all be. It's just I'm trying to promote the best outcomes. So if we don't win business and we're not the top rate or the best product, then we don't deserve that business. But if you do the job and you get all the factors involved in getting the best rate, then your process is strong enough, and the right lender and the right product will come out top. And that won't always be us, and I'm quite comfortable with that. I'm just trying to drive and promote where I see best practice.
Awesome. Thank you very much. Well, just as in closing from me, I have shared some links earlier in the chat. So if you scroll up into the chat box, so to follow both ourselves and just on socials, make sure you're keeping up to date with all your industry updates, product updates, and so on. Similarly with the websites, making sure they're using the intermediary website. If you're not already registered with them as a lender, please do. And likewise for us here at AdviceWise, to watch this session back along with many others, to access the resources, the slides. I know somebody was asking that earlier. We will edit the recorded session and put it onto our upskill section, which I've linked in the chat box as well. You'll be able to download the slides from that too. And then we will, as usual, do an email follow-up. So to get your CPD certificates, you have to request them yourself. So watch out for the email that comes from us over the next day or so, certainly before the weekend. And you can click the button to request and download your certificates that way as well. Thank you to obviously Matt for joining us today to add in some extremely valuable content for us. Thank you to all you delegates as well. I know it's quiet. I know we're getting ourselves set up for Christmas, so it's all important to get those CPD hours in and track them through, making sure we're doing what we can for our customers. And that's everything from me. So yeah, thank you. We can say this now. We're in mid-December. I hope everybody has a very Merry Christmas, a great New Year, and yeah, hopefully we'll see you all and have a successful 2024. Thank you all.
What's on? Thank you.